Okay, so we're going to talk about the markets and the benefits of seg funds.
Yeah.
And thank you, Jason, for joining us
Well, thanks
on.
for having me.
I'm also going to say that it's the first week of November so that people know the timing of this.
November
Just
2nd to be exact, if we want to talk.
exactly. Because things change so fast.
Yes,
You're watching
exactly.
this next year, it's 2023. So
That's right.
it's also important. We might take it down before then, but that's okay.
All right. Sounds good to me. No, I think, when we talk about the markets, there's a lot of similarities and commonalities to different periods of time. And so it doesn't really matter whether it's 2023 or 2008. There's going to be a lot of similarities to the stuff that we do. So we'll
Okay,
talk about.
that's awesome. And I think it would be good to talk about things from, an aggressive or a more growth portfolio to a balanced portfolio to a conservative portfolio. Everybody in those areas has had different experiences over the last year and a bit. So I think if we could touch on each of those three kind of from a overall view, then we can,
Sure.
if people don't know what they're in because they didn't buy one fund that's called growth or balanced or conservative, then we could let them know after if they have a question.
Sure. Like, well, let's start with kind of probably the biggest one, which is our more conservative clients being conservative. So when we think of being conservative, we're thinking of fixed income, think of maybe a little bit of equity. So typically a fixed in or a conservative client will have the bulk of their money in bonds or something like that. So about 80% and 20% in equities is, there's always some variations, but it'd be similar to that. So that's probably been the big one over the course of the last year. And so we think of, last year, we entered 2022 with, fairly low interest rate environment, abnormally low coming out of the pandemic. And what we saw with the central banks over the course of 2022 is, especially in the first half of 2022, really accelerate the rate increases in what they call the overnight rate. So that'd be the Bank of Canada rate or the Fed rate in the US. And by raising those rates, what we saw is it put a lot of downward pressure on the bonds that were out there. And so for a lot of clients who look at that as their safe part of the portfolio, it was a really challenging period of time. But most of that happened in the first 6 months of 2022. And since then, the rates have definitely, we still seen them go up, but they've been a bit more moderated. It's allowed the portfolio managers who manage those assets to manage the marketplace a little bit better and maintain the capital or maintain the capital a lot better. But there's one benefit to this all when we talk about it. So in the short term, it's been very hard and it's been very painful for some clients. But one of the nice things now is that within all that fixed income, clients are able to get reset, and these managers are able to reset at higher rates. So as we move forward, the fixed income is actually going to start acting like fixed income within clients' portfolios and providing that ballast that maybe hasn't really been there in the last decade. So I think, from a longer term perspective, what we saw was kind of a reset for a lot of clients. And I think that's going to be a long-term benefit, but on the short term, understand that it's not as easy. But one thing I like to note, is last year we saw, a period of time from January 1st to really July where it was really challenging. But I had a conversation with, another advisor and another client, and we looked at a scenario where they looked at taking money out at the end of September last year and put it into a GIC. And at the time, you could get a GIC for somewhere in that 4.5% to 5% range. But they were in a balanced fund going into that. And so by staying in the balanced fund over the course of the last 12 months, to the end of September this year, they were able to get about 7.5% rate of return on the balanced fund. Whereas that GIC that they would have bought a year ago was only around 4.5%, 5%. So even though there was a lot of pain from January 1st to into September for them, by maintaining that, they're actually able to do better than by just going into a GIC. So not saying that GICs aren't, necessarily a good thing for clients. I think they can be a very good piece within a client's portfolio, but really more short term. And when I talk about short term, I'm talking about that 1 year, 2 year type of goal. So if you're going to buy a house or you're going to be going on that, that dream vacation to Africa or something like that, then, you put that money into a GIC because that's where you want that security. But when you're looking at retirement, you're looking at 20 years out. We know that the markets have these ups and down cycles, not always easy, but it's really one where if you want to stay ahead of inflation incorporating some equities into the portfolio can be a very it's the only tried and tested way to maintain against inflation, right? So
Hmm. Well, I think that's also tricky because people want to buy the GIC and lock it in right now, but then they also want to time their re-entrance back in. But if everything has gone up again, they're missing that upswing. And so you can actually lose quite a bit in that time period, but your GIC is locked in. So it's
100%. So
not usually appropriate for all your money, I think is one of the very big caveats that should come with it.
for sure, that's a big takeaway. It's not for all the money because yeah, there's an opportunity cost or opportunity lost cost, I guess, by locking it in. And it goes back to as you know, I was an advisor myself for 18 years before I joined Canada Life. But I remember having a conversation with a client in the fall of 2008, and it was kind of exactly that thing. We had those conversations about where the market was going and what it was doing, and we talked about what their plan was. We talked about, they still didn't need the money for 10 years. We had a plan in place, and so we talked through all the different scenarios and exactly that. At the end of the meeting, basically the client said, yeah, if we take our money out today, lock it in for a year, and we think the market's going to come back within the next year, we're going to miss out on that growth and that upside. And so to that point, yeah, I remember having some of those conversations, and I think it's important that when you're working with advisors like yourself, that you spend that time looking at the plan. You can make some adjustments. You can take advantage of maybe some of the GICs for part of that money to take care of the shorter term part of your portfolio. But over longer term, having that diversified portfolio of other assets like bonds and equities really help boost your returns and allow you to stay ahead of that inflation that we're
Well,
running
and
into right now.
right now you have a promotion on your money market, right?
Yeah, we do. So up until the end of April, I think it's April 26th, we're going to make sure that money market funds don't go below 4%. So they're currently paying over 4% right now, but we're going to just ensure that we make sure that doesn't fall below that 4%. So for that short-term money, while you're taking an opportunity to understand what's going on with your portfolio, make sure that your plan is in place, you can make sure that you're not going to get anything less than the 4% in that. And what's nice with a money market fund versus a GIC is it's completely liquid. And so
Yeah.
you can cash it in at any point. There's no fees in doing that. And so then that way you're able to take advantage of whatever opportunity might arise and redeploy that money into what would be more favorable for your situation.
Yeah, that's really helped with some of the conversations. It's still liquid. You can still move it around if you wanted to get back into the market or use it for something different. It's available.
Yes,
It's not stuck. Well,
100%.
things get
Exactly.
better from the
That's
sideline.
right. Exactly. Yeah.
Yeah. So what would your advice be when we're looking at somebody in a growth portfolio? They're not doing too badly right now. So I don't think we have to do a lot of changing, but then there's people still in the conservative ones where things are down and they're like, do I do some money market? Which is kind of locking in the loss that they're still showing a little bit on their account. Would you recommend some of that to some people in the situation? They don't need to spend it right now, but that's where I think the conversations are becoming tricky.
Yeah. We'll talk about the growth investors here right away as well, but go back to the conservative and taking some money out. And that is one of the challenges that if you don't need the money right now, you know, we're locking in those losses. When you sell lower, you're locking them in. And that's, you have to kind of look at it as in the context of your whole plan. And so that's
Mhm.
where advisors like yourself, working with your clients, you can kind of lay out exactly what is the plan, when do we need this money. And the story I like to use is, personal story to myself. And when my dad passed, or not my dad passed away, my mom passed away back in 2009. She passed away in February. And I was helping my dad with his money. So the pension money, insurance money, all that, we were taking care of that. And we were so happened to be putting that money to work for us in April of 2009. And so for those, who are listening to this, for yourself, I know you know this, but March 26th of 2009 was the bottom of the market. And so I did not know that when I was doing that. And so, my dad always said to me, like, if you mess this up, I'm going to come live with you. So I didn't want my dad to come live with me. But what we really did is we would put that plan together. So, okay, what do you need for short term? And when I talked about short term for him, it was like the next 2 years. And then we talked about what the medium term was, and then we talked about the long term. And I think we've talked about this, Crystal, is kind of using a cash wedge type of strategy for those type of clients, and that's exactly what I implemented for my dad. And so even at a time when the world was still falling apart around the financial crisis, and we really didn't know we were at the bottom at that moment, we had a plan to play in place, and we stuck with that plan. And my dad just passed away a few years ago, but one of the things I loved about that is he's able to do all the things he wanted to do. He's able to see the money continue to grow. And I think when I look at the markets today, we're kind of in that similar situation. There's a lot of noise out there. There's a lot of uncertainty. But if you have a really good, solid plan in place, and sometimes that means having a little bit of that safety, and maybe it can be the right thing. But we don't want to do it all, because we are going to lose that opportunity. But if we have a solid plan that we can allow us to sleep well at night, knowing that we have the money that we need to spend to pay for food and utilities and all those other things that we want to do or need to do. But having that long-term plan in place can really allow us to navigate these choppier waters. Like going back to the growth clients, I think in this case here, something to keep in mind is, and these are at the end of September, but if we look at the S&P 500, the S&P 500, don't have the exact numbers, but give you a good illustration here. At the end of September, the S&P 500 was up around 13.5%. But that's 500 companies. If we take 7 companies out of there, so they're called the Fantastic Seven or the Fabulous Seven, there's different verbs for them right now. But you take those 7 companies out, the returns on the S&P 500 fall down to less than 3%. It's around 2.5% year to date at the end of September. So we're November 2nd here, so a month difference in the numbers, but it gives you an illustration that the markets are more than just a number that you see on BNN or in the newspaper or flashed across the screen. It's understanding what's going on behind the scenes and what those numbers are coming from. And so I'll throw this out there: is those same 7 companies were down collectively last year 30 to 40%. And this year they're up collectively 55%. With one of those companies was down 75% last year. So there's a lot of things that happen in the markets, and this is where guidance by advisors like yourself can really help clients navigate through this. And especially with growth, and even our conservative clients out there, it's having that plan in place and understanding that having a diverse portfolio that's not just based on Canada, US, international, but its style of investments, so value, dividends, growth, really come together to help smooth out that return profile. And I think what's unique, and I know before our call today, we were starting to chat a bit about this, but we've been in a unique environment with interest rates for the last decade where they were really low. And so it's been great for real estate. It's been great for a lot of spending and things like that, but it's also created a very smooth, relatively smooth marketplace for 10 years. But if we go back in the previous decades with a more normalized interest rate environment, the markets have been a lot more up and down. And so that's something I think, it's not going to be easy for us all to get used to, but I think that's going to be something we have to become more aware of and more comfortable with as we go forward. And that's the importance of having that diversification and having a plan in place, because that's going to allow us to navigate those choppier waters a lot easier, know that we're okay, and we have a plan to get to the other side.
Well, I think our capacity of working with Canada Life and the other carriers that we work with the segregated funds only.
Yes.
When it goes above and beyond that, we hire other people, bring other people into the mix and collaborate. But with our capacity with Canada Life and the other carriers, it's segregated funds. And each of those funds has a mandate, and each of those funds has special parameters that need to be understood. But they're also professionally managed by a fund manager. So in some situations, it's McKenzie or Beetle Goodman, or, there's a list of managers out there. And it's really important for clients to know that it's their job to operate that fund and buy and sell within that fund to the mandate of the fund.
100%.
They don't always win. It's their job 24 hours
100%.
a day, and they don't pick winners every single time.
That's right, 100%. And I think when you partner with Canada Life, as we've talked about in the past, is when we look at our fund shelf, we have about 100 different segregated funds, and 69 of our funds are 4 or 5 star rated with Morningstar. So that just shows the consistency of their mandates and the performance. that they bring to their peer groups. So Canadian, US, international equity, even fixed income, and our managed solutions. So one of the nice things, like you mentioned, is it's professionally managed. So these are the same managers that are managing, here in Alberta. One of the managers we had out last week, Aristotle, who manages some of our U.S. holdings, they're looking at working with Aimco. So anybody who's in Alberta, Aimco, they're looking at working with them. So Aimco is looking at bringing in a company like Aristotle to help manage. Those are the same managers that you have access to as well with Canada Life. And that's the kind of the beauty, is that it's not me or you making the decisions on a day-to-day basis as to what companies to go into, but we're hiring managers that have a philosophy that fits with what we're looking for as a client, as an advisor. It could be dividends, it could be growth, it could be value. But we go hire that manager who has that mandate or that style that we're looking for, that fits with our philosophy, and allow them to kind of do that. Doesn't mean they're going to win every day, but over time, they show that consistency and they take the emotion out of it.
Correct.
And I know we've talked a bit about the emotion part of investing, and that's probably the biggest risk when it comes to investing. And I'm guilty of it as well, right? It's easy to look at that statement and go, oh, like, it's tough. I get it. I've been there. I'm there myself. But I have trust in the managers because I believe in what they're doing and it fits with how I think about investing. And by attaching that with my own thoughts, I'm able to navigate the waters and let them do their thing. And I'll share a few pieces with you after this, which you can maybe share with your clients as well. But just kind of showing what happens by leaving your money invested, showing kind of how different markets work at different periods.
Thank you.
And so sometimes those are showing periods of how long it takes for a market to recover after a down period. So those are things that really can help paint that picture for clients and even for advisors like myself and yourself, to see how the markets are working, but also just give us some confidence and give us some a path forward. Because I think in periods like this, that's probably the biggest thing, is trying to navigate through all the heavy waters, right?
And I mean, the additional features of the segregated funds help too with people. So I've noticed, right? They're
Yeah,
guaranteed
SIG funds are.
a little bit of extra protection they have on creditor. On the non-registered, it's really big right now with some of our clients who know that they have 100% death benefit guarantee. So even if they went a little bit more aggressive and their funds are down, or they're pretty conservative and they're down right now, they know that if something happened to them, that money's still going to the people right away. They know that, and they know it's going to get topped up. And I
100%, yeah.
pay out
Oh,
like that. I've had it happen one time where it got topped up, and that was this year. So it's interesting to see the power of that actually happen.
yeah, 100%. It doesn't get talked about enough, and I think seg funds are one of those tools that I don't think get talked about enough. They aren't understood enough, and so when people don't understand it, it's easy to dismiss it. But I'll be honest. When I think of seg funds in the first part of my career, I didn't really think of them much in my planning. But something that's become a lot more apparent to me is over the last number of years, and think back to with my dad, with my mom passing and my dad, we used a safe fund structure to help transition the money from my dad to me and my brother as beneficiaries. We used that structure because it allowed the non-registered money to flow to us. So for those who don't understand how that works with safe funds, one of the benefits is in non-registered accounts, you get some of the state bypass because you can designate a beneficiary just like you do on your registered accounts like TFSAs, RSPs. But also one of the benefits with seg funds is you also have different payout options. And so this is really great where you have maybe multi-generational families or multi-generational people that you want, or maybe you have a spendthrift, beneficiary that you want to make sure that is getting money over a period of time. You can actually structure that all within the seg fund contract, which is something you can't do outside of the seg fund. So it's a fantastic tool from that perspective. And one of the other things you mentioned was the guarantees. So you have different levels of guarantee with the death benefit being one with at 100%. And so that means that you invest that money and you're looking at leaving some money for your grandchildren or your spouse or whatnot. You want to take a bit more aggressive approach because you don't need it to live on a day-to-day basis. So you can take a bit more aggressive approach, but knowing full well that the amount of money that you put in there is going to no less than that's going to be passed on to your beneficiaries because of those guarantees. I think one of the other things that on seg funds that was unique to Canada Life. We're still one of the carriers that offer 100% death benefit across
Yeah.
all of our funds. So I think that's a good thing. But the other one that we have is what we call estate protection. And so this is for our clients who are between the ages of 80 and 90. So before your 91st birthday, you can deposit money into a select group of managed solutions within our estate protection series. And that gives you 100% death benefit from day one. So for older clients or clients whose maybe health isn't in great shape, the estate protection can be a solution that allows a client to still invest for that longer term mindset or for that growth mindset, but allowing them to ensure that they know that if the market does go down, they're still going to make sure that all that money goes to the kids that they want to or the beneficiary. And so
I
that's
find it
just
really
another
helpful
option. Is
with
that?
grandparents. I find it really helpful with grandparents. They want to leave money for grandkids or great grandchildren, but they don't want to go get another life insurance policy, and they
Yes.
want to make sure that if they need it, they can access it.
Yeah.
So we just carefully invest it, and they know that the guarantee's on there. And it's really an interesting experience when you show up at a family's home with a handful of checks for kids and grandkids and great grandkids. That
Yeah.
is something that changed my life in my career. And not a lot of advisors get that experience early on in their career, but I have the privilege of working with an older block of business. So it's pretty interesting to actually see those things happen, and the impact that it has on a family when they're really prepping for a celebration of life that day and you're able to deliver all of the funds so quickly. It's amazing.
Yeah, and it is an amazing thing. It's never a fun experience to have to go
No.
through that, but knowing that you can bring that news to the clients and having a tool like a safe fund contract that allows you to do that, allows you to really do the wishes without having to go see the lawyers or set up expensive trusts or things like that. You're able to do a lot of that within the contract, and something that also doesn't get talked about is the privacy that it can provide as well. Because it doesn't go through the
Beautiful.
courts, it doesn't go through the estate, it doesn't go through the state. So there's a lot of privacy that can be very important to clients, and it's easy to set up. They just have to meet with you. They don't have to go see a lawyer, which you're a lot nicer to talk to than a lawyer. So
Hey, I have some lawyer friends. They're pretty awesome.
the lawyers are good. No, the lawyers are there to help us, but
They charge a lot. People are afraid, right, of that bill that's
100%.
with that
Yeah, and
conversation.
it's intimidating, right? Let's be honest.
Yeah.
And so that's where the SIG funds can be a really good, valuable tool. And I think the other one, we haven't talked much about it, but is for corporate clients.
Oh, great.
SIG funds can bring some creditor protection. They can
Yeah.
bring stuff like that can help with them and their business as well, protecting their assets, not just for themselves, but for their family as well. So that's SIG funds have a lot of things because it's under the Insurance Act. From tax reporting standpoint, it simplifies things because we do all that work for you. When you sell things, we take care of all the tax reporting so that you just get one slip. You don't have to, you don't have to calculate it out yourself. So the fantastic part is that SIG funds do provide a nice, simple solution for a lot of challenges that clients can come up with.
Yeah, that's awesome. We've really benefited from using them in our practice where they're appropriate. And I just really appreciate the fee structures, being able to be as transparent as possible with Canada Life, so that clients can actually see what they're paying for their investments. I think that's really important. I think people need to know that people are being paid to do their job, because no one does a job for free. The managers don't do a job for free. Canada Life doesn't operate with no expenses.
Yeah.
Jason, you need to get a paycheck. We all have kids to feed. So I love that it's broken it out. And we were one of the first firms, I think, to just start switching every account we could into that transparent structure. And it's caused really incredible conversations. People are shocked that they're actually paying for their investments.
Yes.
And I think when you talk about it and say, look, if we were charging you an embedded commission, you wouldn't see these numbers, but your return would have been reduced because your fees actually reduced through this structure that we put in place.
100%. Yeah.
It's really been, I think it's been relationship building, and it's been a good experience overall, I would say, and I hope the clients feel that way too. But that's one of our biggest things, is that there's no sneaky charges. And if I say to the client, if I'm not happy with Canada Life, or if you're not happy with Canada Life, we can leave and there's no penalties the way we've set this up. I think that's important, to hold people with an open hand, to give them that freedom with their money so they don't feel trapped and afraid. We need to encourage people to have good feelings with their money.
100%. And I couldn't agree with you more on that. And, it was a great segue into, one of the things with Canada Life is we have the fee structures for different clients and different advisors. And one of the fee structures is what you're just talking about, the fee based or transparent, where, the your fee is very much out there. You negotiate that with your clients as in terms of what you're charging, and then overall, it usually typically lowers your fees as well. And yeah, when you talk about the relationship building and the great conversations that it creates, that's been my experience as well. As I mentioned earlier, I spent 18 years as an advisor as well, and that's the business that I ran as well, fee based, and where it was very transparent. And I've always found that having those conversations just leads to deeper conversations around the planning and what we're trying to achieve, because everything's out on the table. And I think that's an important aspect. And I think in the industry that we're in, there's so much information and so much noise out there that we kind of need to cut through that clutter. And that's something that you've always done a great job with in our conversations as well, Crystal, is just cutting through the clutter and the noise that's out there and really focusing on this is what you're telling me is important. And so this is how we're going to do things, because this does that for you. Doesn't mean it's always a smooth ride when it comes to the markets. We don't have control over that. But if we understand exactly what we're doing, how we're doing it, and what the plan is, it just makes it for a better relationship and a deeper relationship with the client. So I would agree 100% with you.
Thank you. Well, I really appreciate you coming and sharing a bit about some of the experience in the marketplace, giving us some more materials in the background, and talking a bit about how segregated funds can be beneficial for people.
Yeah, I'll send you off some pieces on that, which you can share with your clients as well. It talks about the benefits of seg funds and how they can be utilized within their planning. So again, just provide some additional information. So we're here to partner with you and partner with your clients as well, to ensure that they have the information that allows them to sleep at night and to feel confident in working with yourself, so that that the money is well taken care of and well managed and one of the nice things, and I'll leave it with this on Canada Life. Canada Life's been around 175 years, I think it is now. It's been a long time. And we're the longest. We've been around the longest for insurance carrier in Canada, and we're a trusted partner. For many years, and so I think the benefit for yourself and your clients as well is that we have that track record of paying out. Making sure that all our clients have always gotten their insurance checks or their top ups when they need them, when they're supposed to be there. And I think that should provide that confidence for your clients to know that they're not in just good hands with yourself, but in the good hands of your partners like Canada Life and others.
That's right. I mean, we did have the question come up when the markets aren't doing well. People think about strange things. So what happens if something happens to you? Is my money gone? No, your money is with Canada Life, and Canada Life has additional insurance through Assurance. And here's how all of these things work. It's similar to CDIC, which is the Canadian Deposit Insurance, but it's actually more robust in my opinion.
Yes.
But your money is protected so many ways, and I think people need that security when things are uncertain, and they need to know that their protection was the priority.
100%. And, that's the benefit in partnering with companies like Canada Life and some of your other partners as well, is that you have that assurance and that confidence in what they bring to the table, and not just in investment management, but also in making sure that their assets is secure as well.
Right. Thank you. Well, we really appreciate you and all the questions that we throw your way on a weekly basis.
Anytime. Thank you for having me. I appreciate getting an opportunity to talk a little bit about the markets as an overall and just some of the benefits of working with Canada Life.